coming to the final scenario where C has opted for composition scheme and not A and B. The situation for A would remain the same. 1000 sale price, 200 GST, invoice value of 1200, output tax of 200, and because he doesn't have any input tax credit, his net liability is 200. Now the case of B would go back to the first scenario. B has chosen the normal scheme. His purchase cost would be 1000. On that, he'll add a 10% profit margin, so his sale price would be 1100. On 1100, he'll collect GST from his customer C at $220, so his total invoice value would be 1320. His output tax liability 220 reduced by input tax credit of 200 to give a net tax liability of 20. Now, coming to C, this is where the change would be because C has opted for the composition scheme. The purchase price of C, 1320. Notice that 1320 includes the GST of 220. Same logic, he cannot claim input credit, so this 220 would form part of his purchase cost. On this, he'll add a profit margin and his sale price would be 1452. He cannot collect any tax from customer, so his invoice value would be 1452. Assuming that his GST prescribed tax rate is 1%, we'll apply 1% on his turnover in state, that's his total invoice value of 1452. So that gives us a rounded up figure of 15 for his tax. No input tax credit allowed. So his net tax liability of 15, which will also be his expenditure. So to summarize, A and B, the purchase price of B does not include any tax. So as the stage till B is concerned, there is no cascading effect. But the purchase price of C includes GST, and so cascading effect has been introduced at stage C. And this is their final net tax liability position. For A and B, it is not an expense, but for C, that 15 is an expense. So the final profit statement. For B, the profit is 100, just 10% of his purchase cost, that's his profit margin, and that's his net profit as well, because tax liability is not an expense. But for C, his 10%, 132, 10% of purchase cost minus 15. So 117 is his net profit. So let's put together all the three scenarios. We have invoice value, purchase cost, profit, and net tax liability. The total tax that the government would get from the first scenario where all three dealers have opted for normal scheme is 242, 200 plus 20 plus 22. In the second scenario, here's a shocker. It's a whooping 503. That's more than double of the first scenario. Remember, the middle one, B, has chosen for the composition scheme, 213 and 290, 503. In the third scenario, interestingly, where C has opted for the composition scheme, the tax collected by the government cumulatively is 235, which is even lesser than what it could have collected when all three have chosen for the normal scheme. Interestingly, the government is getting more tax if the middleman is opting for composition scheme and not the dealers in the two ends of the supply chain. The final cost for the consumer would also increase in this case because cascading effect is quite high for the middleman. He'll pass on that tax to the next customer in the supply chain, who's also a dealer, a wholesaler. So this way, the cost of goods would in turn become higher. In the first case, the cost of good to the final consumer is 1452. That's the same in the third case, but in the second case where the middleman has opted for composition scheme, it is 1742. Quite a lot more than the other two scenarios. So it isn't really good for the economy for all the same reasons why cascading effect isn't good. And so, should you opt for this scheme or not? Well, the answer still depends. It depends on your position in the supply chain and 2 on your cost saving trade off. If you're the middleman, your customer who would be interested to claim input tax credit might not be willing to buy goods from you. That's also a factor to keep in mind. So, your position in the supply chain definitely affects your choice to opt into the composition scheme or not, along with all the advantages and disadvantages that we've gone through in great detail earlier of lesser complications, saving of cost in maintaining a tax team, an expert, or an auditor, but on the other hand, tax expense because you cannot collect tax and you cannot claim input credit. So, should you opt or not? The answer depends on your analysis of these two criteria. Now you know how to analyze the situation, so go ahead and analyze whether you should opt or not.